Very good morning, everyone. Very good morning. Audio, video, all good? Please let me know. Audio, video, good? Yes? All right. So, I hope you all are doing good. Welcome back again in this editorial series. So, today I have picked two editorials. One is from your, as you can see, this one. This one is from your Indian Express and this one is from your business line of The Hindu, right? So these two are basically taken together to form a comprehensive analysis. Basically, these are talking about the recent MPC meeting's decision not to cut the repo rate, right? So all of the articles are like this only and some are very political. So this was only useful and we can have an analysis of why MPC is not aiming to reduce the key policy rate. Why is the case that MPC has stood by its stance of withdrawal of accommodation. So this entire analysis will roam around this topic, okay? Right? So let's try and understand and what all factors are there, how can we link all these things, right? So as this editorial says, caution, no cuts ahead, means no rate cuts, right? So key policy rate, which is your repo rate, has been capped at 6.5. So in the meeting, it was expected that the rates will be higher because inflation is higher, right? And in this, you can see reason to pause. What are the reasons why the RBI has taken a pause, okay, or not to reduce the key policy rate, going with the flow of higher key policy rate, right? So this is the thing. Let's see. So that's why I have put the title repo standing tall against inflation, right? Now, withdrawal of accommodation. Withdrawal of accommodation. So this is the first title. As you all know that this stance is known as withdrawal of accommodation. You are very much clear with this concept now. What is accommodative policy? What is accommodative policy? Accommodative monetary policy is basically when the central bank or the monetary policy committee tries to increase the money supply, okay, by reducing the key policy rates, the reserve requirements and all. But when we say that the stance is withdrawal of accommodation, it means we are withdrawing from the accommodative stance, rather we are trying to implement the tight monetary policy. Yes, the opposite of it, right? Reducing the money supply, contracting the money supply so as to contain the inflation. Okay, I have got this question, so I'm going for PNB-SO interview. Okay, should I read financial news also of recent months? Yes, you can do that. First of all, congratulations to you if you are going for interview. That is a good achievement, right? I wish you good luck, all the luck. May God bless you for the interview. And one thing, see, you know, it is very difficult to say if something is useful or not. Try to understand this. So what I can say is, I cannot deny that they cannot ask a question from financial news, right? Are you getting my point? You never know how interview unfolds, right? So it would be on a safer side. Being on a safer side, you can refer to these financial news. They can be asked from you, right? So be on a safer side and go with the news, and also go with these analysis. They will help you in the interview, right? All right, good. Yeah, so in the RBI annual report as well, we will be having a next session tomorrow, right? So we will complete the series in very best possible manner. All right, so stay tuned with this analysis as well, RBI analysis. So I was talking about withdrawal of accommodation. So the title is this because, you know, the recent MPC meeting has abide by this stance only. So it has not reduced the rate. Now I want you to be very clear with all these concepts: monetary policy committee, withdrawal of accommodation, accommodative stance. What all are these, right? So first let's look at the information, then we will dive into the concepts, right? So robust growth continues to give space to MPC to afford a withdrawal of accommodation. So basically the editorial says, author says that it is the robust growth, as you all know, that apart from keeping the key policy rate unchanged, RBI has also increased its GDP growth forecast to 7.2%, right? Okay, so author is saying that it is due to robust growth which has continued to give space to MPC to afford a withdrawal of accommodation. See, I have started this analysis from this very much important line. Why have I chosen it? It has reasons behind it, right? Why? We are saying, or author is saying, that it is growth, it is higher growth which has given this space, this room to the MPC to stick to this higher key policy rate. So we need to analyze that why higher growth gives space to the Monetary Policy Committee to contain inflation with higher key policy rates. What is the link between growth and monetary policy decisions? Are you getting my point? So we need to understand these linkages because they are not operating in isolation. Their decisions are based on certain economic conditions, certain macroeconomic performances of Indian economy, right? So this is the thing. Now first thing, you should know what is MPC, everything about MPC, Monetary Policy Committee, right? So I told you in one of the classes when I was discussing MPC with you, how many total members are there in the MPC? Let me know very quickly. How many total members are there in the MPC? 6 members, right? 3 from the central bank and 3 from the government side. One is your RBI governor, who is ex officio chairperson by virtue of that post, right? Ex officio means by virtue of that post. That means since presently Shaktikant Das is the governor, okay, of RBI, so he is not the chairperson. The post, the position of governor of RBI is the chairperson. So ex officio, right? He is holding that post because he is the governor of RBI. Yes, 3 from Government of India. Now they will be appointed by Government of India, right? They can be they are subject experts, economics experts, subject matter experts like experts in finance and all. And as you all know, every member has a single vote, right? And RBI has a secondary vote or a casting vote. So when there is a tie, then only that vote will be casted. You know all these things, right? And who mandates the constitution of MPC? From where does MPC gets its power? Tell me. From where does MPC gets its power? So it is basically in RBI Act 1934, there was an amendment by Finance Act 2016, right? So Finance Act 2016 had done an amendment to RBI Act 1934, and that's how the provision of constituting a monetary policy committee was inserted, right? So it is RBI Act 1934 through amendment which was done by Finance Act of 2016. What is a Finance Act? Finance Act or Finance Bill is such legislation which is passed by the Parliament. If passed, then it becomes Act and signed by the President, as you know. So it is basically aimed to insert the financial provisions, to implement the financial provisions of the central government, right? Yes, very good. So you should know the legal backing as well. So this is the thing. Now, since MPC meets every 2 months, so basically 6 times in a year, right? Every 2 months. So these are the decisions, and we always look up to MPC because what are the decisions? They reflect the economic condition of your economy, right? So here author is saying that robust growth has given this space to MPC to stand by the withdrawal of accommodation stance. Now let's see how, okay? So first, this information is there. Then the committee has clearly projected its medium term inflation target of 4%. So basically this has reflected that MPC, Monetary Policy Committee, is clearly aiming at containment of inflation at 4%, okay, which is the medium term target of MPC. As you all know that in case of India, our inflation target is 4 plus minus 2%. 4 plus minus 2%, right? So this is the thing. We are aiming to contain inflation. Now, Now, the RBI governor has stressed that monetary policy did not take cues from the external forces. Now, you should remember that at this time, while you know what is the global scenario, since we are also discussing the RBI annual reports, you all know what is happening around the world as well. From the economic point of view, I am talking about, right? So, at the global level, you know that there is huge inflation. Inflation is beyond the desirable limits. All the major central banks of the major economies have been indulging in higher key policy rates, okay, or tightening of the monetary policy, basically, right? But the governor has clearly stated in this meeting that our decision is not very much, although to some extent it is based on these global scenario as well, but to a lesser extent it is affected by the central bank decisions, okay, of the major central banks like Federal Reserve of US, right? So they are saying that it did not take cues from the external forces like the Federal Reserve, but were a response to domestic growth and inflation dynamics. So this decision is particularly based on domestic growth and inflation dynamics. Are you able to understand this, right? So you should remember that this decision is particularly based on domestic growth prospects and inflation dynamics. Now, I have started this analysis with this particular line only, that robust growth has given space to them, to the members sitting in the MPC, to decide for a withdrawal of accommodation stance, right? Now, how growth has given them space? Why, if there is a robust growth prospect, if there is a good growth forecast in the economy, you can have higher key policy rates. So let's try to link all these things, right? Now, the decision is primarily based on strength of the economy. Domestic inflationary challenges are there. You want to contain inflation, but you can only take this stand if your economy is performing well. If your economy is not performing well, just keeping the policy rates higher would not help. We will discuss it, right? And to a lesser extent, the monetary policy stance of important central banks. It is affected by monetary policy stance of other major central banks as well, but to a very lesser extent. More impact is due to India's domestic growth, which is projected to be higher. The RBI only has revised the growth prospects, as you all know, to 7.2%, right? So this is the thing. Now let's see what all are these conditions. What are the positives which the MPC is looking at, and what are the negatives which has compelled the MPC to keep the key policy rate higher, okay? Now, the Fed Reserve is expected to cut rates only in December 2024. It has reduced the space for monetary policy easing in many of the emerging market economies, which are already facing capital outflow. One thing before the further discussion, you should remember that as you all know, the Federal Reserve, which is the central bank of US, has kept the policy rates higher. Now, it has led to lesser space for the emerging market economies to reduce their rates. Why? Why is this link? You need to understand this link. Whenever one of the most powerful central banks like the Federal Reserve, whenever it raises its key policy rate, why the emerging market economies are unable to reduce their key policy rates? Why is this case? So you need to understand there is a phenomena of capital outflow. What happens is, try to understand. Say this is US Fed, okay? Fed Reserve. This is Fed Reserve, okay, US. Now, since say it has increased the interest rates, right? So tight monetary policy, key policy rates, major interest rates are higher. Now what happens is, as you know, that all other rates, yes, to attract investors, all other rates are linked to your key policy rates, right? When central bank increases the rate, it gives indication to the economy that interest rates need to be on a higher trend, okay, on a higher trend, so as to soak the excess liquidity from the market or the money supply. Are you getting my point? So it generally results into higher interest rates in the economy. Now interest rates of the loan which the bank is offering to you gets higher. Interest rates sometimes on the fixed deposits also gets higher, right? So overall interest rates are on a rising trend, right? So what happens is when you have an increasing trend of interest rates here as compared to say emerging market economies, any of the countries, say country X, which is an emerging market economy, not so developed yet, right? It will face capital outflow. Why? Because investors who have invested into the market of this country, emerging market economy, they now feel it less lucrative. They now feel that it is less lucrative to invest here rather to invest in an economy which is offering higher interest rates. So let's pull out these things, pull out the investments and invest there. Are you getting my point? So that's how these kind of countries face capital outflow going to these nations, capital outflow. Investors want better return, simple phenomena, right? Simple psychology. They want better returns. So they are looking to such higher interest rates. So whenever these interest rates are raised, whenever the Fed raises interest rates, it becomes a concern. All investors are looking at it, right? Are you getting this point? Safe and profitable, yes, in developed economy, right? So this is the thing. That's what I wanted to explain to you, right? Is SEBI RBI report is important for SEBI exam? Yes, it can be. I cannot be so sure that it is or not, but you know, it can be. There can be some current affairs which can be asked, so they can come from the RBI report. So when we are providing you analysis, you just go through it, remember the trend and concepts. Concepts can be asked because you know SEBI asks you economic concepts, right? Pure economic concepts. So since report is there, we are discussing each and every core concept as well, so that would help you in static portion as well, right? No, you cannot say, see, you cannot have a generalized statement if anything is important or not important. Just try to learn this thing. When you are in competitive market, in competition, right? So there is no one source which guarantees selection as of now, right? You cannot trust that this is what will make my selection, right? Otherwise, everyone will be rushing behind it and everyone would get selection. There is a competition because there is always mismatch between the cost to benefit analysis. Are you getting my point? I also do not claim at any point of time that this is going to 100% help you. No, it can. Okay, it can to a certain extent. The extent can change depending on the pattern of the exam. Are you getting my point? You should find out that given this syllabus, this pattern of the paper, previous year questions, is this going to be helpful or not? Got this point? Okay. So this is the analysis of capital outflow. How increasing, they say tight monetary policy or increase in interest rates results into capital outflows from emerging market economies. Now, one thing which you should remember, that why they are not able to increase these interest rates so much. This is my question to you. Why these emerging market economies find it difficult to cope up with the situation whenever the developed country's central bank raises the interest rate? This is because, as the name suggests, they are emerging market economies. What happens is when you are an emerging market economy, you have to develop so far. Okay, for development, you know, you need investment, isn't it? For development, you need investment. Investment will come out of borrowings only. When you borrow from the banks, right? You do not invest the money from your pocket, isn't it? You do not want to risk your money. So you borrow from the loan and you don't have so much of funds to invest in, right? So basically you borrow from the commercial bank or the banking system of other financial institutes. Then you borrow, then you invest. And when you invest, there is economic activity, there is production activity, production of goods as well as services. So when there are these activities, your economy will be able to generate employment, then people will be able to generate income, right? Then you will have demand, and when you have demand, then only the economy will grow, because suppliers will supply, because there is higher demand. Production will only sustain when you have a sustained demand in your economy, right? So you have to keep them lower. If you increase in such responses, in response to such decisions, if you increase these key policy rates, what can happen is your development can hinder, your economic development can hinder. Yes, you want liquidity in the market. You want people to have money in their pockets so that they can demand goods and services. Because if they don't demand, producers will not supply them, because prices will fall, and seller does not want to incur losses, isn't it? And if demand falls to a very lower level, the production of certain goods and services might be cut down by the producers. That would lead to unemployment as well, because no more workers are required, firing out of workers. So all these phenomena are related to each other. Getting my point? So that's why we have a dilemma that, these countries, they have their own economic structure, raising interest rates, but they get affected, right? India also witnesses capital outflows, as you all know, whenever US raises its key policy rate. All right. Now, let's further discuss this. So basically this is the thing that author is highlighting, that Fed Reserve is expected to be on this higher trend only, have tight monetary policy only, okay. So it has basically reduced the space for monetary easing by the emerging market economies or developing economies, right, which are already facing capital outflow. So that might increase. In India, the financial investors are turning into net sellers. So this is the background what is happening. And then there is your decision of withdrawal of accommodation. This is the first global background. Then in case if we talk about India, so the author is highlighting this fact. That in India, financial investors have turned into net sellers in recent times. Net sellers means, if you remember, in one of the editorial classes, we have discussed that pulling out of funds from Indian share market is not very much to be concerned about as it seems to be, because it is due to India's financial market structure. Indian middle class is investing hugely in SIPs and all. Okay, I told you, if you remember, if you are able to recall, that we have studied this thing, that Indian middle class has fallen in love with SIPs, right? They are just doing investments in SIPs. So domestic investment is rising. Now to book some profits due to expected volatilities and uncertainties, like election result was to be declared and all these things. So some investor tried to at least capitalize upon some profits, book some profits, right? That's why sold their shares of securities, part of it, not the entire one. So that's how it shows that still they have confidence in Indian economy. They are just trying to book some profits to reap some profits. This thing we have discussed in one of our editorials, right? If you remember. So here also the author is saying that financial investors in India are turning into net sellers. They are selling out the shares more than they are buying it. Shares, stocks, equity, right? More than they are buying it. So basically selling out the securities more than they are buying it. What does it mean? They are generating profit. They are just trying to book some profits. Are you getting this point? They are trying to book some profits, and so this is the background given by the author. But this is not a huge concern for us. Why? Because we have discussed this analysis in one of the editorial classes, that as harmful as it seems, okay, it is not so harmful. Why? Because this is just a phenomena which will pass by. Okay, it's just that due to election results and all these uncertainties, they were just trying to book certain profits, to reap out certain profits. No, it's not that they have lost their confidence into Indian market. Are you getting my point? Confidence is still there. So this is not a huge concern, but to some it might be, right? That's why it has been highlighted. But you have understood the story behind these things, right? We have discussed in previous classes as well. Second background given by the author is that rupee has faced pressure from the greenback. What is greenback? Anyone knows that? Greenback. So the author is saying that given this decision, you have certain backdrop, okay, certain background. First is investors turning into net sellers. Another, your rupee, your Indian currency has faced pressure from your greenback. What is greenback? Anyone? Greenback is basically a slang for US dollar only, paper currency, okay. So US dollar is, this is US dollar only, right, US dollar, yes, yes, it is US dollar. Why it is called, it is just a slang, okay, it is a slang for US dollars. Why do they call it? Because these were issued during the Civil War, okay, and since then they have been used as slangs for US dollar. At that time they were issued in green and black, green ink and black ink combined, okay. So that's why it became a slang in US to call them as greenbacks as well, green paperback, okay. So that's why wherever you read greenback in the newspapers, it refers to US dollar. It is a slang for US dollar, right? So rupee has faced pressure from US dollar. But if you are able to relate it to RBI analysis, in which we have seen that although rupee has depreciated during the course of time, but it has depreciated by lesser percentage as compared to the previous year. It has been stable, not so much fluctuative, isn't it? We have discussed this thing, right? So although depreciation is there as compared to dollar, but it has reduced, okay, the depreciation has reduced. That makes our domestic currency stand stronger as compared to the previous year, isn't it? So this is the thing, this is the another background which the author highlights, right? Now you have understood all these points. Consumer inflation in India. So author also talks about consumer inflation. Consumer inflation in India continues to derive effects of the supply shocks in agriculture. Coal inflation and fuel prices have moderated, but consumer inflation is still higher. As you all know, we have discussed in the RBI annual report as well that food inflation is the biggest concern, right? From where are we getting this inflation? Try to understand this. Whenever we talk about the effectiveness of monetary policy in containing inflation, it is more when the inflation is from demand side. Are you getting my point? When the inflation is from demand side. When I say demand side inflation, I mean when the demand increases and supply remains constant, right? Demand can increase due to any of the factors which affect the demand. Income of the consumers might increase, price may fall, anything can happen. But when demand increases from the equilibrium level, and that leads to inflation, that is demand side inflation, demand pull inflation, in that case monetary policy is more effective. You should remember this thing, okay? But now the inflation which we are facing right now is more due to supply side shocks. Supply side shocks, why? Climate uncertainties, rainfall uncertainties, heat waves reducing the productivity in certain sectors, affecting the health of the public, right? Also pest destroying certain crops, agricultural crops getting destroyed due to climate change. This is leading to supply side disruption. Now since there are supply side disruptions, supply and demand do not match in the market, demand remaining constant, supply falls down, that's how prices increase. Isn't it? So this is your supply side or bottleneck inflation as we call. I told you that supply side inflation is also known as your bottleneck inflation, okay? Bottleneck. So basically the inflation which we are dealing with right now is your bottleneck inflation. Okay, you should remember this. It is your bottleneck inflation. Now here comes the debate that when RBI knows that the inflation is primarily from the supply side, And monetary policy is not so effective in case of supply side inflation. You need government intervention as well. You need fiscal policies to correct the supply disruptions. Then why have you stood by the stance of withdrawal of accommodation? This is the question put by the author of the editorial, particularly of the Indian Express, right? Interesting one. Let's try to answer these questions, okay? You have understood the background, what is happening, global Indian scenario. Now, why MPC is not in hurry to cut rates even when it cannot control this food inflation, okay? So, you know the background, what is happening at the global level. You have higher key policy rates, okay? Yes, at the domestic level, you are grappling with inflation. At least food inflation is higher, if not other, right? This is the thing. Also, your investors have become net sellers. So, that is although not a big concern, but it seems to be a concern for financial health, right? Despite all these background, and when you know that inflation is primarily from supply side, why are you not willing to cut the key policy rate? This is the question by the author, okay? Now then, the author only has tried to give answers to this question. Let's try and discuss. Before indulging in this discussion and the analysis, I want you to understand this thing, that when is monetary policy more effective in containing inflation, right? Try to understand. As I told you, when there is demand side inflation, because what monetary policy tries to do is, it tries to affect the money supply, the currency in circulation, currency note, currency coins, deposits, right? So, currency in circulation, it tries to affect that, reduce or increase as per the situation. So, say if key policy rate or repo rate is kept higher, the indication of the MPC is we want money supply from our economy to be reduced, right? Liquid, to absorb the liquidity. Now, that will happen how? Let's say the mechanism will be like this. So, if say repo rate has increased, that means the cost of borrowing for banks have increased. Cost of borrowing for banks have increased, isn't it? Since cost of borrowing for banks have increased, they will increase your cost of borrowing as well. They also have to do the monetary transmission. RBI's decision has to be transmitted to the common man, otherwise it would not be effective, isn't it? So, they will increase their lending rates. So, the interest rates which are available, which are offered to you for borrowing from the banks also increases. That leads to increase in cost of borrowing for the customers. Cost of borrowing for the customers increases. You borrow less of loans are offered to the economy, in the economy. So, money supply gets reduced. When money supply gets reduced, people hold lesser cash. And when lesser cash is there, demand gets reduced, and that's how repo rate becomes effective. Are you getting this point? So, if they have had huge cash, they would have demanded more, right? So, we want to address this demand side, but it would have been helpful if the inflation was from demand side. Then this would have resulted in falling demand, and that's how inflation could have been contained, isn't it? Are you able to understand this analysis? Yes or no? Let me know this thing, right? Another scenario at the same point can be that when key policy rates increase, other interest rates also increase. So, say interest on your financial assets, your deposits also increase. So, what happens is people tend to diversify their savings from banking system to those investments, right, which are offering higher interest rates. Or if they choose to hold cash with them, and say interest on fixed deposits and all these increases, then the banking system will be able to absorb that cash from them, because now they have incentive to place those savings with the bank and earn higher interest rates, right? So, this is how it affects the entire economy. But that would be helpful if we were to target the demand. because that's how you reduce the demand which is done by the public, right? But what is happening is the problem is not increase in demand. Then why still we have higher repo rate, and why still we are assuming that it will help in containing the inflation? Let's see the other side, which is the supply side now. Okay, supply side. So basically now inflation is from your supply side. Okay, now what happens is you have kept the key policy rate higher. Okay, key policy rate being higher, you reduce the money supply, people have lesser cash to demand now, economy has less liquidity. How does it affect the supply side? How does it correct the supply side disruptions caused by the climate change? Will this repo rate being higher, increase the crop availability? Yes or no? Not directly, right? Will this increase production, which has the background is that there is lesser production of certain goods, which has resulted into supply side disruptions. Will it increase that production? No, right? Then what do we need in that case? We need fiscal interventions. Fiscal, as you all know, is related to government always, right? So you need government to do these things. Then only combination of your monetary and fiscal policy, then only monetary policy will become effective. Are you getting my point? Or more effective? How government will correct this situation? Say government has reduced, given subsidies on some agricultural inputs. Try to understand this, right? Given subsidies on some crops, announced MSP or announced subsidy for some agricultural inputs, technologies, machinery, right? Fertilizer, pesticide. Pest attacking the crop, subsidy given on the pesticide will help, isn't it? So they can incentivize farmers to produce more so as to correct this supply chain disruption. So you need fiscal intervention here. Monetary policy working in isolation would not help. Are you getting my point? Yes or no? So this is the thing. You should also remember, you should relate all these things. In RBI annual report analysis, in one of the lectures, I have told you that it was written in the report that government is continuously trying to manage the supply chain. Isn't it? We have discussed it. So government is continuously focusing on managing the supply chains. Then only monetary policy can have this strong decision of keeping the key policy rates higher. One more thing, that the GDP forecast is higher. So we have to relate it with them as well. The initial line with which we have started the analysis says that the robust growth has provided this space for this decision. Why? Because when you are expecting the economy to grow, then only you can afford having higher interest rates. Otherwise, as I have explained you, in case of emerging market economies, when you have to emerge as an economy, when you have to grow, you need liquidity in the market. You are only able to absorb the liquidity. When you see that the economy is growing well, so that this decision does not affect the growth trajectory of your economy. Right? Able to understand this? So this is the question by the author, that why given all these situations, why RBI has still decided, when you know that there is supply side inflation and you cannot directly affect that or directly contain that, then what is the situation which has prompted the MPC to be still there on this decision of withdrawal of accommodation? So you should try to understand, and this is one of your question prepared now. Whenever you are asked in exams or interview that is monetary policy solely responsible to contain inflation, you should not indulge in extreme answers like yes or no. You have to have way in between. You have to say that depends. It depends. If the inflation is coming from the demand side, then it would be more effective, but still fiscal policy has to be there, right? If it is from supply side, then combination of fiscal efforts and monetary policy would be effective. Getting my point, right? So not clearly denying the effectiveness, but we have to have fiscal policy interventions as well when it is from supply side particularly. Clear? So this analysis is important. One more thing, I told you that why growth, when you have higher growth, then only you can have these this much tightening of liquidity, because you know that the growth is still there, so your absorbing the liquidity will not affect the GDP numbers, at least. Then only you feel secure to have this kind of decision, because you cannot compromise with the final aim. Be the government, be the investor, be the central bank, be anyone. Our final aim is what? Final aim is to achieve higher economic growth, yes or no? Yes? So this is the thing. Remember, all these dimensions linked together. Okay. Now, moving further into the analysis. So basically this question is posed by the author. Why still, when you cannot control the supply side inflation, you are still with the going with the withdrawal of accommodation stance? So the answer which author only gives you is first, in the post-pandemic level, all the central banks have learned lessons. So firstly, the author says that the pandemic has taught lessons to the central banks. What lessons? That even if your growth is higher, you should not neglect inflation. Otherwise, you have seen the conditions of major economies post-pandemic, isn't it? Yes or no? If you have followed the news, hyperinflations were there. So this has given them lesson that you should not ignore the supply side shocks, particularly when growth is higher. So not only demand side inflation is a concern, supply side shocks may also lead to higher inflationary levels. You should not ignore them. That's why even inflation being primarily supply side, RBI still has had to keep the key policy rate higher. Got this point? Okay. As if growth momentum is strong, the MPC would tend to gravitate towards inflation control even in the case of supply driven shocks. So the author is saying that even the inflation is supply driven. Even in that case, if monetary policy stance is like this, withdrawal of accommodation, gradually you will tend to gravitate towards containment of inflation, because you are continuously signaling the economy that we are absorbing liquidity. Every interest rate, every decision should align by this decision that we need to contain inflation. So gradually it will transmit into the economy, the process which we call as monetary transmission. Isn't it? Agree or not? Quickly respond, please. Agree with this point of the author that yes, Corona has taught us that you should not ignore the supply side shocks as well, otherwise you can have to face the brunt, right? Good. Then the second point, or not the second one, only adding to this food inflation, which is a combined result of inclement weather, pest attacks, etc., is expected to get normal as the IMD has predicted above normal rains this year. One more thing, since first is the lesson which you have learned that even if there is supply shock, you need to contain inflation. That's why the inflation being supply driven, still we have withdrawal of accommodation stance. But one thing, why are you positive in this outlook? If you have kept the inflation higher, knowing at the same time that the inflation is driven by the supply side shock, not by the demand, and your policy does not directly affect the supply disruptions, then how are you able to manage this, to come out at this decision? Because the MPC is very much optimistic. Optimistic about what? Optimistic about the future conditions. Presently, this is driven by your climate action, right? Your inclement weather, pests attacking the crops, okay? But what Indian Meteorological Department has forecasted that this year will be above normal rains year, okay? So we can witness above normal rains this year. So when above normal rains happen, you can be optimistic for this thing that the crop increases, the crop yield increases, right? Yes, future outlook is positive, but we need to remain watchful. Very good, very well tried to explain, right? You need to be watchful even if you have a positive prospect for growth, isn't it? So supply, RBI is expecting that due to above normal rains, supply shocks will get corrected. Agriculture, the production in the agriculture, the supply disruptions will get corrected. That's why they are positive. They are looking forward to these corrections. And as it happens, as and when it happens, that would automatically get reflected into your agricultural commodity prices, particularly food prices. Then we might expect them to revise this stance in the next MPC, whichever happens at that time, right? MPC meeting, okay? So this is the thing. Then second reason provided here by the author is that food, which has 39% weightage in your consumer price index, has kept inflationary expectations high. Why RBI has taken this stance? Apart from the situation which is supply side, knowing the situation that it is supply side, is this food inflation, as you all know, and you know that food is has around 39% weightage in CPI. CPI is your consumer price index. You all know what is CPI, right? CPI is released by NSO, right? National Statistical Office, under your Ministry of Statistics and Program Implementation, right? So given this thing, the inflationary expectations are higher. Yes, very good. So due to this expectation, since it is obligation of the committee to contain the inflation. Obligation by what? By the RBI Act. Getting this point? That's why they have decided to do this. Then next, third situation which is given here is rising uncertainties in the Middle East. As you all know, Middle East geopolitical tensions going on, okay? And you all know that our import bills are heavily dependent from the supply chain from the Middle East, as we import oil, we import gold, isn't it? So our oil and gold imports are heavily dependent on the supply and the price level from the Middle East. So given the uncertainties and the geopolitical tensions in the Middle East, it is exerting increasing pressure on the commodities like oil and gold. So that's why, and oil, as you all know, is a very huge commodity in our import bill, particularly an import bill of every emerging market economy or developing economy, even for developed economies, right? So we cannot ignore this situation. Getting my point? We cannot ignore these upcoming inflationary pressures in all these commodities. That's why RBI, given the fact that supply side inflation is there, has decided to keep the key policy rate higher. I hope you have understood all these arguments by the author. Yes or no? Yes? Okay, I am only giving the answer because I assume that it might be clear to you. Okay, so this is the thing. Now, moving ahead. Therefore, the author says that therefore some caution is warranted. So RBI is presently playing like a playing on a watchful side. Okay, to be specific, that it is more watchful, although optimistic of the situations getting corrected, but cannot ignore the present pressures coming from all around. The sources of inflationary pressures coming like from Middle East, food inflation, all these things, as you know, right? Okay. Now, this caution is coupled, the author also highlights that this caution is coupled with strong growth. As I told you, it is the strong growth due to which this decision has been taken. Otherwise, it becomes difficult to absorb liquidity in such a huge economy where you are still grappling with the issues of unemployment, poverty, lower per capita income, lower standard of living, all these things. Why are you able to tighten the liquidity? Strong growth prospects, right? As RBI is optimistic for the growth, and that's why the RBI only has revised its growth forecast to 7.2%, isn't it? Then further in the analysis, the author says that rising GST collections, increasing bank credit and penetration, and more fiscal consolidation are also providing space to this decision. So this decision is not coming from isolation, not coming only from the inflationary pressure point of view. Getting my point? There are certain other phenomena, other economic performances of our economy on which we have performed well, which are providing cushion to this decision. They are acting as a cushion, as a safeguard to this decision, so that the decision does not lead to the economy entering into a negative peril. Getting this point? So why? What are those cushions? Rising GST collection is one of the cushion, one of the buffer, one of the safeguard. As you all know, GST revenue generated from GST is continuously rising, and it is helping government in fiscal consolidation as well. We have resources to spend, so we can absorb the liquidity, right? Then increasing bank credit. If you remember the analysis of RBI annual reports, talking about the banking sector, I have told you that the report says that bank credit has increased. There is a credit growth in the economy, right? So you can relate it to that. Credit growth is there, that even due to, given the higher interest rates, people are still demanding for loan. The demand for loan has not seen a substantial downward pressure. Getting this point? So since credit growth is there, so RBI is optimistic that okay, it is not going to affect the pockets substantially, right? Then credit penetration. Okay, this word is very useful when you, credit penetration is what? These are terms related to your financial inclusion. Okay, credit penetration, deposit penetration, that how much remote areas are you able to cover in this thing, say credit penetration. So by how much far-flung areas have you been able to reach out to people to integrate them with your credit system or banking system, to make them avail credit facilities, to say reach out as institutional credit. Okay, so we want to increase institutional credit in the economy, non-institutional ones are not preferred, right? So this is credit penetration. So reach of credit, institutional credit is increasing in India, right? This is a good concern. That's how it has provided safeguard or cushion to this decision of RBI, right? Then more fiscal consolidation. Very good. Your username is AA. Okay, I don't know the name. Thank you for this. And if you are able to read these documents and understand what is going on, that then our hard work is justified, right? So it is just to make you understand, make you help and understand what are these new news going around, so that you cannot, you do not turn the business pages and those pages having economic news. You try to understand everything which is happening there, right? That is good. Just keep on studying. It will help you only. So one more thing, that fiscal consolidation, government trying to manage its fiscal policies better, manage revenue better and cut out on unnecessary expenditure, simultaneously having good capital expenditure, simultaneously increasing capital expenditure, as we all know from the RBI report analysis, right? So these are certain reasons which have provided cushion to this decision. Then only the MPC could decide to still have the withdrawal of accommodation stance. Are you able to understand this entire thing now? Right? They are providing some space or safeguard to the RBI to keep its stance higher and aim at coming closer, keeping the stance higher for coming closer to what? Coming closer to your target of 4 plus minus 2%. See, I deliberately try to use these words, these contrasting statements and all to attract your attention, okay? Keeping the stance higher, coming closer to inflationary target, so that you are able to understand what is happening. Okay, simple statements written, you might get bored, so I try to make them somewhat interesting. That's why I keep on using these words, right? So this was the analysis, and I hope you have got to learn out of it. We have related this decision since to GDP growth, okay, higher GDP growth. We have tried to understand what all have worked behind the curtains for giving this space, this cushion, this stability, this safeguard to the Monetary Policy Committee to come out to this decision. So it is the economic performance of India only which has led their confidence into Indian economy and then deciding the key policy rate to be kept higher. So we should congratulate our economy that we are working good, we are performing well. Okay, although we need to improve, there is always a scope of improvement, but at least we should acknowledge what has been done, right? We should acknowledge what has been done. So this was the analysis, and this was the editorial for today. I hope it was useful. That was it for today. Any doubts? Any questions? I am waiting if there are any doubts so that I can address them. Otherwise, I will end this session here. No doubts, right? All right. Good then. I'll see you in the next session. Okay. Tomorrow we'll be having the RBI annual report further class. Okay. Next session of the RBI analysis and the editorial as well. So, since tomorrow is Sunday, if there is an important editorial, then only we'll take the class, right? Because generally on Sundays there is no as such relevant article related to economy or finance. Okay, so I'll see whether there is something or not. Otherwise, your RBI class will definitely happen tomorrow, right? Thank you so much. Have a very great day. I'll see you in the next class. Thank you.